I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for joining me in person at last today.
It's good to be back together, and it's good to be back in person, yes.
Yeah, it's great. So we're sitting down at VRIC. Have you had a chance to be down on the floor? What's the atmosphere like?
I've been down on the floor, and it's pretty well attended. There were a lot of people asking a lot of questions of the various mining and junior mining and exploration companies. So I think it's a hesitant but optimistic environment.
Okay, good. I can't wait to make it down the stairs out of this room. So starting off, we spoke last, I think about 2 months ago, right around the time when Russia and Ukraine, the war was just beginning. You told us to expect more volatility in gold and other financial markets, and certainly we have seen that, especially in recent weeks. So my question today is, would you say the war is the main source of that volatility, or are other events now playing into that too?
No, I think the main source of the volatility right now is the interest rate policy of the Federal Reserve Board. I think that has supplanted it, and we have seen the war and what we call the war premium to be very important in March and April. But one of the things that we've been writing about, and in fact last night in my hotel room I was writing about, is the idea that the war premium has dissipated somewhat. And the biggest and most important factor has been the interest rate increases and the Fed signaling a much more strong anti-inflation stance.
Yeah, and so I think people are definitely, concerned about what's going on in the markets, probably justifiably so. So I want to ask your best advice for, when it comes to dealing with volatility.
Well, I'll give you two types of advice. My mental advice is take a deep breath and be calm, because there are a lot of people who see the world in black and white, and it really is shades of gray. So you have people saying, well, they're going to either kill inflation and throw us into a recession, or they're going to let inflation run. And the reality is there's this spectrum of activities. And over the last 40 years, the Federal Reserve Board and other monetary authorities have really learned a lot about managing monetary policy. And it is quite possible that the Fed will succeed in quelling inflationary pressures insofar as it's possible for the Fed to do that without throwing us into a recession. So I think the first piece of advice is to stay calm. The second piece of advice is I love options and I love hedging positions. We provide hedging services for commercial companies, and we provide hedging services for investors. And if you're long the stock market at this point and you're hearing all of these crazy people waving their arms saying that the stock market's going to fall 70 or 80 or 90%, and even if it's going to only fall another 10 or 20%, it's very easy for you to keep that long position in the stock market and buy some puts to protect yourself against it. So I'm a big fan of hedging. And so my second piece of advice is more mechanical, and it's you really should be hedging your positions long and short.
Okay, and let's talk a little bit more about the Fed and inflation, because I remember that you are more optimistic than many people I speak to about its ability to rein things in and get it under control. So we are now 2 rate hikes in. How are we doing on inflation? How's the Fed doing?
Well, yeah, there's how we're doing on inflation and how the Fed is doing. And so far, I think the Fed is doing okay. It's interesting because we have seen the April CPI and PPI. And as CPM Group has been saying since 8 months ago, simple arithmetic means that the PPI and the CPI will be smaller this year than they were last year. Last year, you're measuring year-over-year price levels in a very strong economic recovery compared to 2020, which was a very steep manufactured recession. No one was buying anything in 2020, prices were low. Everybody was buying everything in 2021, prices were high. You had 6, 7, 8%, 8.5% inflation. And if you looked at the month-to-month changes, that inflation really started to pick up in April of last year. So we're really only 13, 14 months into a period of higher inflation. Now in 2022, and you're starting to see this with the April numbers, you're measuring 2022 against 2021, when inflation was already high. So you're starting to see some reduction, and it's purely a mathematic factor. Prices aren't falling, but the rate of increase in prices in percentage terms, which is what people look at and which fuels that market sentiment, is lower. And as you go forward, June, July, August were the highest months. The second quarter was strong into the third quarter for inflation last year. So as we go forward and we're looking at May to May, June to June, you're going to see less inflationary pressures.
Okay, and the path forward for the Fed, because another thing that I keep hearing is, they have raised rates twice so far this year, and many people don't think that they can get very much further. What's your view there?
They can go a lot further. I mean, they have raised interest rates twice, and they've raised interest rates very aggressively. And interest rates now, like if you look at the 10-year bond, it's just around 3%, which if you look at the 10-year bond rates historically, they were never below 3%. They were never at 3% from the 1960s until about 10 years ago, 15 years ago. So in terms of the level of interest rates, they can go a lot higher before they really start to kill real demand and real borrowing. And if you look at it on an inflation-adjusted basis, they're just now crossing zero on the 10%. And in terms of shorter-term rates, they're still deeply in negative territory in inflation-adjusted terms, and they're very low, 0.75% on nominal terms. So the Fed still has a tremendous amount of capacity to raise interest rates without killing the economy.
Okay, yeah, and recession is another big theme right now. You started to talk a little bit about recession. So I know that you've said we could see one further out. So what is your outlook on a recession looking like at the moment?
It's really hard to, you cannot econometrically, mathematically say the next recession comes next year. So it's really an artwork. But you look at, you set your palette by looking at data. And you look at capacity utilization, you look at labor market slack, you look at residential and non-residential construction. And there too, we have a lot of slack still in the economy. So I don't see necessarily hitting the limits of growth that would trigger much higher inflation, which would trigger a recession. I do think it's coming, but I wouldn't be surprised to see if it's 2024 or 2026. There are a lot of people who are saying it could be as early as 2023, and I'll grant them that because, again, it's very hard to say when a recession starts, how long it's going to last, and how deep it's going to be. Because all of those things, while I look at the data, all of those things are more heavily influenced by the market's collective perception of the data than the actual data.
Right. So we've got kind of a picture of what's going on, at least in broad strokes. If we put all this together, what does it mean for gold and silver prices this year? I'm kind of wondering about upside and downside for both of those metals.
Right. Well, we had been predicting that the prices could move sideways for most of this year and that you could see some weakness in the second and third quarters. We're halfway through the second quarter. We're seeing some weakness. We're actually seeing more price weakness in gold and silver than we had expected at this time. We thought that silver could fall to $21.50. It fell to $20.50 last week. We thought that gold could fall to $17.80 maybe in July or August. It fell to $17.85 this week. So we think that the markets are vulnerable for the next several months to some further price weakness. Rising interest rates, lower inflation figures. The Ukrainian war is going in the Ukrainian favor. There are a number of factors that could reduce the demand for gold and silver and lead to somewhat lower prices. But there are these much bigger issues that have gone unresolved and are being added to and are growing in power. And those things are going to keep the prices from falling very far. So we're still looking for prices to be a little bit weak in the next few months, but basically move sideways into next year. And then at some point, those bigger issues become much more prominent and much more demanding of public attention. And then you start seeing a revival of investment demand for gold and silver and higher prices.
And that's what's hard to see coming, but we know it's coming in the future. So I want to hone in briefly on silver because I know CPM Group recently released the Silver Yearbook. So I wondered if you could tell us a little bit about that and if there are any key statistics or points that you would pull out for people from that release.
Sure. I mean, the 230-page book, there's a whole lot of data
exactly.
in there. And I really could want to talk about silver reserves, mineable reserves, and what's going on with silver mining. But the single most important thing is investment demand. And you saw a period of time, 2017 to 2019, when investors were very bearish on silver. And they were buying 40 million ounces of silver physical net investment demand for about 3 years there. And the price fell down to $15, $16 an ounce. In 2020, and it's very important to remember 2020, in 2020, net investment buying of physical silver went from 40 million ounces to 80 million ounces. It doubled. And the price of silver rose very sharply from $15 to $25. Actually touched $30 in August of 2020, but the average price was about $25, $26. Last year, we saw another 37% increase in investment demand from 80 million to like 110 million or so. And the price of silver basically rose a little bit more. But it didn't go back to that peak, and it basically was consolidating. And this year we think that investment demand is a little bit lighter because there has been, you've seen investors back away from buying as much silver, and we think that the price could come off a little bit. But we're still looking at prices in that $20 to $28 range.
Okay, and that's interesting. I'm just going to ask one more thing about silver because you're really highlighting the investment demand. And I find that people often focus more on the industrial side of silver. So, but would you say the investment side is outweighing? That's the key point right now.
The industrial side creates a base for silver prices, but the marginal demand, which comes from investors who can come and go or just ignore silver, really sets the changes in the prices. So industrial demand is very important, but if you really want to know where prices are going on a shorter term basis and on a long term basis, you have to look at the investment demand.
Okay. I think that's everything from me, unless you had any final points that you would leave investors with during these very interesting times.
Well, I think you asked me the right question earlier, which is, what's the advice? And my big advice is to stay calm and to think reasonably. In the case of silver, we had a lot of people come in touting silver last year, and it was going to go $50 or $100 or $700, and it didn't. They said they were going to squeeze the silver market, and they didn't. Silver inventories are at record levels. There's more silver in refined form around the world today than ever before. So the silver market's well supplied. The decline in mining output is basically a cyclical thing that will change with the higher prices now. The average cash cost is about $8 an ounce, and the average fold-in cost is about $13 an ounce to produce silver. So it's very profitable to develop these mines. And I think the people need to be calm. In one of the sessions this morning that I participated in, somebody said, well, the Wall Street Silver Boys, they 200,000 new people coming into the silver market. And I said, no. You have to look at that investment demand numbers I gave you earlier. They have 200,000 people who signed up to watch their videos. If you look at the investment demand surged in 2020 when those guys were like working at McDonald's or something. They weren't in the silver market when investment demand went from 40 to 80 million ounces and the price made that big move. And if what you see is a lot of people who invest in silver and have a lot of questions about the ugly state of the world, and they have a lot of questions about what it means for silver, and they go online and they look for, confirmation. They look for information. Some people look for information, and this is what they find. Other people look for confirmation, and this is what they find. So the fact is, if you look at the flow of silver into investor holdings, it predated the Wall Street Silver Boys. They have done very well in getting 200,000 people to watch their videos, but there's very little evidence that they have done anything other than a one-day marginal increase in physical demand for silver.
Okay, I think that's good information for people to remember. It is hard to you find the facts out there. So thank you for stopping by to talk. It was great to hear from you, especially in person.
It's always a pleasure.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.